Hello everyone, welcome to today's edition of the Final Bar. We'll do our normal Friday Wrap the Week segment where we'll really take some focus off the short term back into the long term, understand the big picture trends that are operating. In our mailbag segment today, we're going to answer some of your questions from the last couple days about the AAII rankings, about moving averages, also how to find symbols for breadth. We'll finish with the 3 and 3 today. This is the Final Bar. Hello everyone, welcome to today's edition of the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. A very chilly day here in Redmond and I know across the US. So thanks for joining me today. What is not chilly which is the markets, which is having a lot of activity, a lot of volatility, a lot of movement. And what we're going to do today is, as usual, try to connect the short-term fluctuations that we're seeing with the long-term trends. Want to remind you, the mailbag segment we're going to have later today, you can always get questions to us via email, thefinalbar@stockcharts.com. You can also get to us on Twitter @FinalBarSCTV. But we love to make this show interactive, love to hear from you in terms of what you're seeing, what you'd like to see. So any feedback, any questions, please keep them coming as we continue to refine the show going into the end of this year and beyond. So we're going to get right to the market recap today. A lot of fluctuations. The market sold off pretty aggressively in the morning. Felt like it was going to be quite a distributive day, and then it completely reversed after 11 and into the lunch hour. Rallied very, very nicely, sort of settled in and spent the remainder of the day at fairly elevated. So the S&P 500 finished up 0.2%, 21 basis points. The NASDAQ just under that, 0.16%, excuse me. We've talked a lot about large versus mid versus small. This was one day where they were really in concert. They were really together. So all three of them finishing within a rounding error of each other. So no real theme there. A lot of times we've had, large caps finish strong, small and mid caps lagging or something like that. Not the case today. They're actually pretty homogeneous, which is interesting. Let's look at some of the charts. We'll look at the chart of the S&P 500, and then we'll get back to some of the sector themes and elsewhere. So if we're looking at a chart of the S&P again, this is the last week, these last 5 bars here. So on Friday into Monday, we had this nice rally, the gap up on the chart of the S&P 500. And again, if you're looking at the spiders, a little different, especially the opening prices are a little different because it's an index, but overall directionally going to be pretty much the same. So we had a nice beginning to the week. Friday was a huge up day. Tuesday, Wednesday comes down, and then Wednesday was the real distribution. The last couple days, it's been weaker over stronger. Today, maybe a little bit of a difference where we're opening and closing toward the higher end of the range. You almost might call that a dragonfly doji if you're really into candle charts. We had a session very briefly talking technically with Tom Bowley yesterday, talking about reversal candles, and I know dojis are a key part of that if it's part of your discipline. So thinking of the long term on the chart of the S&P, we've pulled back just a skosh down to 3,100, and that's sort of where we've settled in, closing around 3,110. I mean, overall, still in a very constructive part. There are always going to be fluctuations, so don't let yourself get too excited when there's a big down day or a big up day. We think Charles Dow's theory was it's all about a series of highs and lows, and where the successive higher highs or lower lows, that's the direction of the market. So even though we pulled back a little bit midweek, we traded up into the close today to finish the week a little bit above those lows. But overall, we've now established a higher low on the short-term chart from the low we had last week. So that continues this pattern of continued strength. So there's nothing on the chart of the S&P at this point telling you anything other than the trend is still positive. So you would need to get two things to reverse that, which we have not seen yet. Step one, a lower high. And that's something we, potentially would have to look for. So, the high back here around 31.30, we need to get above there to continue this pattern of higher highs. If we fail to reach that level, you then look for it to break the most recent swing low, and potentially 30.90 would be where that is. So that's the two-step process indicating that the market has reversed on this tactical time frame. We have not seen that yet. What we have seen is an overbought market that's settled down just a touch, and the question is, do we resume into next week or do we continue lower? Next week is obviously a bit of a challenge because of the holiday, right? So you've got the holiday at the end of the week. You've got a lot of lighter volumes. Markets tend to be up in a marginal way on a holiday like that just because the volumes are usually pretty light. But overall, on average, tends to be stronger relative to weaker. So we'll have to see probably not a lot of signal in the next week, but into December is when you really get some color as to what's happening. Let's look again to finish off today's, and then in our Wrap the Week segment, we're going to touch on a lot more of those long-term themes. So today, we had financials up the most. Financials, consumer discretionary were the two leaders, both up about 0.7%. So no dramatic winners a couple times this week. We had energy up a couple percent or something like that. Nothing that crazy. It was sort of a lighter, sort of a more sideways overall market, but plenty of differentiation between financials and consumer discretionary at the top. Down to the bottom, we have energy, and then real estate, really the big loser. So real estate, again, had been one of the biggest, strongest sectors with utilities. That's now rolled over, now sort of continuing a new downward leg, continuing a little further distribution. Looking at some of the themes that we see at the industry level, at the ETF level, Brazil, Mexico, Singapore, all up today. Looking at our global ETF basket, Brazil obviously is a very commodity-oriented market. So when commodities do well, you're going to see Brazil pop up pretty nicely. Let's look very quickly at the chart of commodities here. And we can see, looking at the CRB or looking at the GSG, for example, that's today. So the last couple days, pretty strong, reclaiming the 200-day moving average, which is interesting. The GSG, this is the GSCI commodity index, sort of like the CRB index, broad measure of commodity strength, less exposure to oil, which is why some people like it. Now broken above trendline resistance, putting in a higher low and then and sort of rallying from there. So that something like that is going to tend to propel a market like Brazil fairly well, Mexico as well. At the bottom of the list, China down pretty big, depending on how you measure it. The KBA is really geared toward the A shares. The others not down as much. So that one particular part of the Chinese market down pretty significantly. At the industry level, a lot of really interesting themes, a couple of sectors within materials and energy at the top of the list. And again, the reason why I like looking at all the industries together is there will be times when things like coal or aluminum stocks are up. And unless you're looking at all those industry groups, if you're too focused on just the large cap names that you're going to miss a lot of the opportunity. And again, the benefit is equity investors. You have so many different levels you can pull, so many different industries, so many different sectors to play at. So something like materials usually is off people's radar. Pay attention to when these names start to pop up, then look at the individual charts of the groups, look at the industry summary page, see what sort of themes you can uncover. Some interesting charts in materials right now. We might look at that going into Monday of next week. Our next segment is Wrap the Week, and every Friday what we love to do after the close of the week, we've got the weekly closes locked in. Let's intentionally take a step back, think about the big picture. And again, one of the main themes of this show is to understand the long-term trends, to get away from the short-term noise. Think about how today's movement fits into the long-term, and Friday's a really natural time to sort of review that. And hopefully you have a discipline or a routine either over the weekend or Friday evening, Monday morning, some time when the market ideally is not open, to review some of these themes and just make sure that you've centered yourself, you've primed yourself for thinking about the long-term trends. So let's start with the long-term trend of the S&P 500. This is a weekly chart of the S&P going back about 7 years. This is the main weekly chart. As you can see, this is sort of the process that I go through when I'm looking at stock charts, and one of the first things I look at is the weekly chart of the S&P. It's the first chart I look at, and it's to pay attention to the long-term trend, make sure I'm orienting myself with that perspective. So this is how today's trading, really this week's trading, fits into this long-term picture. Overall, the primary trend is undeniably positive. So regardless of what we hear about news, about rumors, about buyouts, about tweets, any of that stuff, is inconsequential relative to the fact that the primary trend is higher. And until proven differently, remember, stay primed to the fact, stay biased, positive, because that's overall what the trend is telling you. The reason why I say that is because we have higher highs, higher lows. We're above 2 upward sloping moving averages. All those things tell you that the market's in pretty good shape. We're going to go to the Mindful Investor Live chart list. If you don't have access to this, if you haven't seen this before, just shoot me a quick email, thefinalbar@stockcharts.com. Ask for this chart list. I can email you a link to it, which you can bookmark and then review these. And I update them. You'll see the updates on your side. It's a pretty cool way to review the charts together. But the first one I look at, this is a trend following model that I've used for years. It's that same weekly chart, but now I use the 21 and 34 week exponential moving averages, and that's the blue and the red lines that you see on the top. And again, very simply speaking, as long as the 21 is above the 34-week exponential average, overall the trend is positive. When they reverse lower, that tells you that the trend is no longer positive. And it's a very simplistic way of just looking at a bunch of different markets, and I run that model on a number of different broad ETFs. It's a way of just orienting yourself to where the trend is. So overall, the trend is in good shape. It's positive. This is the difference between those two moving averages. Pretty strong. That's positive as well. The PPO or the MACD is very, very similar. This is a little short-term, more tactical way of analyzing the trend, and it's a traditional trend-following tool. Are they trading, flipping up or down through one another? This model turned positive in the middle of October, so this is my very long-term secular model. This is more my tactical short-term model. Both of them positive, both of them suggesting, long and strong up and to the right, pretty healthy market. Looking at breadth by cap tiers, this is a chart we've looked at a number of times, and I have the S&P at the top, and then I've got 4 different breadth lines. This is the S&P 500, the New York Stock Exchange, which is a little broader universe, and then mid caps, and then small caps. And I color code these every weekend based on where the trends are and are they in primary uptrends or downtrends. So this is based on advanced decline lines. So it's not the price, but it's actually the stocks, the components of those indexes, and if they are making, going up or down every day and accumulating that over time. What's interesting in the last couple weeks, and this is a good wrap the week sort of theme, large caps continuing to slope higher, mid caps flattening out, small caps rotating lower. And again, that on its own is not a raging sell signal by any means, but what it does tell you is there's a little bit of a disagreement whether or not the trend continues higher or whether there's some distribution happening. And it's essentially an equal weighted measure because it's just counting the number of stocks that are up and down. So a lot of times you will get divergences on the small and mid cap advanced decline lines, the S&P, even before the broad index itself starts to roll over, sort of your early warning system. So the fact that the small cap AD line has now broken down through this trend line that I drew from the high in September, I've drawn that on each of these points as sort of the initial warning sign that there might be a little bit of divergence. Not quite a sell signal yet, but something I'm certainly going to be paying attention to going into next week and beyond. Here we're looking at new highs and new lows, and I'll orient you here. The top is the S&P 500. The bottom panel is the new highs and new lows on the S&P, and it's a histogram. So the green bars are every day how many stocks making a new 52-week high. In red, it's the number of stocks making a 52-week low. You can see how these are diverging as well in the month of November. So higher highs in price. These lines are sloping downwards. The reason why I'm not pounding the table telling you this is a really dangerous sell signal is because it's happened a couple times before, and especially the last time, which was at the end of October, didn't really pan out, right? We had this similar pattern. You saw the market going to new highs, saw less and less stocks making new highs, and it was a warning in my head, but then that completely was violated as we had an influx of new highs as the S&P went to new all-time highs at the end of October. So, again, it's sort of the beginning. It's the early warning. It's not a confirmed sell signal by any means, but it's something you pay attention to. Here, we've talked about this chart. This is the percent of S&P stocks above their 200-day. Again, this means that a lot of stocks are in a primary uptrend. That's a good thing. What has concerned me is if you look at when this line has hit about 75%, you will notice that it lines up pretty much perfectly with market tops in the year 2019. So we once again have now made new highs. We once again have a percent of S&P stocks above the 200-day right around 75. That tends to be what sell signals are made. It usually indicates a short-term market top. So how do we reconcile that with what we've talked about previously, which is the fact that the trend is just positive? So breadth measures like this are fine, but if the trend still remains higher, you've got to be owning stocks, right? You want to bet on that primary trend. I don't have an answer because we have to wait and see how the market is resolved. But that is a question. That's a disagreement that I think we need to be aware of and following for sure. We'll have to see. If we start to see some failure, start to see the percent above their 50-day roll down and establish another lower high, that might tell us to hold off just a bit. Now we're getting into some of the ratios, and I love looking at these ratio charts once a week at least, just to get a sense of where the trends are, make sure that we understand things. And just a couple I will highlight for you, and then we're going to look at some scooter rankings before we wrap up this segment. So first, the ratio of consumer discretionary versus consumer staples. Consumer discretionary names up pretty good today. That's why this ratio has popped up. But overall, the trend has been negative. And until this ratio gets above this trend line resistance, the trend is still negative. So again, based purely on offense versus defense and consumer, certainly not confirming this bull market that we've sort of established going into year end. The second one that I think is really interesting is the relative performance of semiconductors. Again, this trend is really important to follow because the market tends to do well when semiconductors are outperforming. It tends to do poorly when semiconductors are underperforming. And you know what, the causation of all of that is irrelevant in my mind. I find that this is a leadership group, tends to be a bellwether group. So when the markets are doing well, people tend to bet on semiconductors. And what's happened in the last week going into today is this ratio has now rolled over. It's again still in a primary uptrend. We're still making higher highs and higher lows. So overall, the trend is still positive, but if this is the beginning of something that starts to break down, then that would tell you to be wary. So you get this theme as we're looking at a lot of these charts. Plenty of things looking very positive. Any trend following measures certainly in positive mode at this point. A lot of things are suggesting we are nearing some sort of end point. The other one that comes to mind, we had Trevor Neal on earlier this week on Monday, if I remember right. We didn't talk about the DeMark indicators too much, but the TD sequential model, which is one of the models that he and I have followed for a number of years, gave a sell signal this week on the S&P. So, just before we sell off. So there are a number of things telling you there's exhaustion to this trend. So again, for me, that's fine. I just want to see follow through. I'd want to see a breakdown that would confirm that that's really the case. Let's switch now and look at some of the scooter reports. We're going to go to the industry summary. We're going to go to I'm going to go to the scooter report, sorry. Charts and tools. At some point, I will learn how to use our platform. Here I am. 1 week. I'm looking at the scooter reports, and I'm going to U.S. industries. So where this is helpful is it shows you which groups are at the top of the list. What are the strongest groups? The top 3 groups right now are computer hardware, semiconductors, so 2 within the technology space, and then healthcare providers, which has emerged as a real big one. You can see that this is up 15 points in the scooter ranking. So it was way down this list. It's now elevated to the top. The chart of healthcare broke out. We used that as our mystery chart yesterday, if I remember right. That's one of the reasons, because providers have jumped up so much. And then if you flip it, you'll see what's down the most. But let's look at the big changes. So investment services popping up. Obviously, a lot of the M&A news with TD Ameritrade, with Schwab. A lot of stocks moving related to that and to rumors on that. The other big movers, a lot in healthcare. So pharmaceuticals, biotechnology, medical supplies, 3 groups within healthcare, all one of the top 5 movers. So if you're not in healthcare, if you have not been paying attention to it, I would encourage you to take a look, because there's some charts that are even extended at this point because they've broken up so much. On the downside, pay attention to some of these groups. Fixed line telecom, that's AT&T, Verizon, CenturyLink, specialty chemicals, which is in materials, and also home improvement retailers inside consumer discretionary. So again, if you're not using these scooter reports, I'd encourage you to do so. They're a great way, especially at the end of the week, to get a sense of what's moved and where you might find some opportunities chart-wise and investment-wise going into the next week. We're going to take a quick commercial break. We'll be back opening up the Final Bar Mailbag. We'll see you in a minute. Hey guys, welcome back. Great pitch right there for Julius DeKempener Show Sector Spotlight. If you've not checked it out, tell you what, I followed Julius's work for years as a customer, following him as a broker, a publishing broker. We've remained friends, and it's such a joy to be collaborating with him here at StockCharts. Check out his show on StockCharts TV if you haven't. Really good thinking about data visualization, in particular with sector work. Let's get into the Final Bar Mailbag. So this is one of my favorite segments because it allows me to address directly questions that you guys are sending into us. And again, please keep them coming. The Final Bar at StockCharts.com. It can be anything about the StockCharts platform. It could be about technical analysis, could be about investing, behaviors, any questions that you have. College football questions related to Ohio State's dominance over Penn State tomorrow. That would be a fair question as well. But I digress. My brother's a Penn State grad. I had to get that in there. So your first question was on the AAII charts. I showed this, I think, earlier this week, and the question was in particular how I constructed this chart. And I will tell you, Arthur Hill, who's been a fantastic mentor on how to use this platform. If you don't watch his show or read his blog, you're really missing some things because he uses the product so well. But he showed me how to create these histograms, and for me, it was something like this where it's a sentiment read, and it's bullish and bearish, and you want to see the relationship. Using the colors and using the histograms allows you to sort of compare those two, and it makes it so obvious this week. We're talking about a big jump down in the AAII bullish rating from 40% down to 30-ish%. So how did I construct this chart? The trick is at the bottom. So we actually have this indicator called price up down pair, and it does this, and it's such a cool little feature. And then you just put the two, it'll automatically add 2 spaces for tickers, and you just want to put in these tickers, AAII bull with an exclamation point at the front, and AAII bear, sorry. And so I'm basically price up down pair is an indicator. It's in this list of all the indicators, and then you can see the two. So you can add anything that you would want in there. It works really well with sentiment data, anything that is sort of has boundaries, data that has boundaries. This is not going to go past 100%, and so it creates a really cool visualization. And then the horizontal lines, I just put them on myself as visual aids, trying to line up where we're at relative to where we've been. So that is how I designed that chart. You are more than welcome to try and recreate it. If you have problems, shoot me an email to thefinalbar@stockcharts.com. I'm happy to send it right to your login if you like. The second question was about moving averages. So as you can tell from this show, I try not to be completely ADD flying around 8 million charts, but when you like charts, it's so much fun to go around very, very quickly. And so the question was, what moving averages am I using? And to be honest with you, I use a different series of moving averages. 99% of the time, if I'm looking at a daily chart, this is a chart of First Solar, one of the solar stocks. Solar names, by the way, really interesting group to look at if you haven't. This is FSLR, perfect example of Fibonacci retracements coming down to the 38.2 or 61.8% level last month, now bouncing back up to the midpoint. But having said that, I use the 50-day and the 200-day moving averages, and 99% of the daily charts I show are using those simple moving averages. Why do I use those? Number one, I've been using them since I started learning technical analysis in the year 2000. Also, I spent a lot of my career visiting institutional investors, and most, if not all of them that I ever met, if they looked at a chart of a stock, it had the 50 and the 200-day moving averages on them. So I've seen them take action when the price hits one of those points. They look at the slopes of them just like I do, and if I can use something that helps me get inside other investors' heads, I'm going to do that. The other times when I use other things is when I look at longer term charts. If I look at weekly charts, I usually use the 40-week moving average because that lines up with the 200-day for the most part, and then I use the 150-week. And that's what I show on my main weekly chart that we're using. I also have a couple other models that I'll randomly show. This is the one using the 21 and 34. So if I'm ever showing anything other than those, I will try to make a point of pointing those out to you. But that is, those are the moving averages I use and why I use those particular settings. The third question, and again, thanks so much everyone for sending in. These are actual questions from all of you. I really appreciate it. Keep it coming. Was about how to find some of the symbols. So I showed a chart with the percent of stocks above their 200-day moving average that's on our list. So this is new highs, exclamation point, new high NYC. This is the advanced decline line. It has these tickers you probably don't know. So how do you find those things if you're trying to create your own charts? Here's what you do. On the toolbar at the top of StockCharts, go to the far upper right corner, and there are a couple ways to do it, but this is what I found is easiest for my brain. You click on the little magnifying glass, and then type a keyword. So if I say like 200-day, and then hit enter, it's going to show you, we have a bunch of different things we can search on. It starts out searching on articles related to that keyword, so it's a great way to find, if there's an indicator you're not familiar with, this is the same way that you would find it. But if you change support articles to symbols, it's going to show you this screen, and this is where you want to get. So now I've done a keyword search of all the symbols with this keyword in the ticker or in the title, and now I can see XPXA 200R with the $ at the front is the percent of S&P stocks above their 200-day moving average. That's how you do it. So again, the way you get to those random obscure tickers you might not be familiar with, don't worry about it. Click on the magnifying glass, type a keyword, and then just switch to symbols and you'll get this list. And then these are the tickers that you can plug into any of your charts that you're interested in. The final question that I wanted to address, and again, thank you all so much, and this is a very broad question, so I'll give a very specific answer just because we're light on time on a Friday afternoon. It was, what is your routine for going through stocks? I talked with one of the guests this week, and I feel like last week about a routine. I remember talking with JC Peretz down at the Las Vegas Traders Expo, a routine of how you go through stocks. And there are a number of ways of doing it. I've managed analysts and I've coached advisors and I've worked with a lot of investors over the years, and the ones that I found to be most successful have a disciplined routine for going through charts if they're technically oriented. And so what I do is I have a chart list that is this one, S&P by sector, by industry, and by market cap. And I look at this chart list, 10 per page, which basically just shows you one at a time. It starts, and again, setting one of these up takes some time on the front end, but then it makes your weekly routine absolutely easy. So I start with AT&T, which is the biggest fixed line telecom, so I'm looking at communication services, then this subgroup, and then I'm looking at Verizon, then I'm looking at CenturyLink, then I switch into the same sector, but the next group, entertainment, and I'm looking at Disney, and I'm looking at Netflix. And about 500 charts later, I have gone through the S&P 500 in about 30 minutes. I try to do that on a Saturday or Sunday when I have a few moments, and I make notes longhand on a piece of paper. But for me, that is the way I do it. The real question you should be asking yourself is, what is your routine? How can you set this product up so you can get a good routine that you will stick with every week? And I challenge you to think about that into next week, the holiday week. We are going to wrap up the show with our 3 in 3, 3 charts in 3 minutes. And if these charts are not on your radar yet, they should be as of this moment. The first one for the 3 in 3 today on Friday, the 22nd, is the S&P 500 breadth by cap tiers. We look at this often. We talked about it in the market recap segment. This, again, is not a raging sell signal, but it's the beginning. It puts it on my list. I like having a list of charts that I think are actionable, because a lot of times charts don't really give you a directional call. It's more just information. This is something that's starting to illustrate a theme that I think might be playing out into the end of the year. Going into year end, you usually have this window dressing situation where things that were down a lot, people will tend to unwind. Things that were up a lot, investors and big institutions will rotate there so that their portfolios look really, really good at the end of the year. And again, seeing how that sort of lines up with what we're seeing here with divergences in breadth, I think will be a really important theme over the next 4 to 5 weeks. The second chart is pharmaceuticals. I mentioned in our Wrap the Week segment how many of the healthcare groups are up at the top of the list and have improved the most in their scooter rankings over the last week. And I think that's a really important theme. I found a lot of investors are not thinking about healthcare because it's sort of been a market yawner, a market performer, and the relative strength, nothing to get too excited about on the the pharmaceutical index, DRG, but it's breaking to new highs. It's new closing highs. It's above resistance from July. Overall, in pretty interesting shape. Why this is interesting is we potentially have a bearish divergence here, and I think that's one potential signal to watch there. The third for your 3 in 3 is Cisco. I tweeted this out earlier today along with a quote that I love, which is never confuse the bottom of the page with support. A lot of times when a stock goes down a lot, I find people get really excited because it's at the lower end. And if there's one thing I've learned over the years of doing this is that just because a line has gone down does not mean it can't keep going down much longer than you can remain solvent waiting or owning it or losing money on it. So just because Cisco is down a lot on its own is not a reason to buy it. Looking for some signs of accumulation, looking for divergences, looking for oversold conditions, looking for an improvement in relative strength, all of those things would be the ones that I would try to be looking for on a chart like Cisco. So at this point, it's now gapped down, broken down through price support. 46 is a really key resistance level. Until it eclipses that, I think you have to wait. I think you have to avoid, and I think you have to go to happier, greener pastures until we find a good reason to own a chart like that. That is our show for today on Friday, November 22nd. Happy birthday to my mother, Joe Keller. Wanted to wish her a happy birthday for sure. Wish all of you a really good weekend. Please keep your questions coming to us. The Final Bar at StockCharts.com is the best way to get a hold of us. Send all of your questions, all of your feedback. We're thinking a lot about this show going into year end, how we can make it better. So I'd love to hear from you on what we could do to make it more worth your time every day. For StockCharts.com in very chilly Redmond, Washington, this is Dave Keller. Have a really good weekend.